For a closer look at the macro, I am joined by David Bahnsen. He is the founder, also the CIO at the Bahnsen Group. He is on the line from Newport Beach, California. David, thank you for making time to chat with me. Can we talk about what you saw today in not only the data, but the way in which the bond market performed? That was a pretty big move in the 10-year. I think we were down about 10 basis points. Do you think the bond market is getting maybe a little too ahead of itself, given the fact that we still have a lot of uncertainty on this spending bill that is yet to get out of Congress?
I think that the bond market is properly responding to growth expectations. So this is a rally in bonds for the wrong reason. It's not coming from declining inflation expectations or greater stability. It's coming from declining real growth expectations. If we want a 10-year around 4 to 4.3, you really want that because you're getting somewhere around 1.5 or 2 inflation expectations, and then another, 2 to 3 real GDP growth. We're not getting that. I think that the other side to this coin is very important, though. When the yield was up around 4.5, and everybody said, "Oh boy, the bond market is really revolting against this spending bill," that was rather exaggerated as well. So my own view is that the bond market is in a very tight range, actually. It is not pricing in a big extreme either for recession or for some sort of runaway fears about where the debt is going. My fear is that the debt is going too high, but it isn't the bond market saying so. It's just our expectations of real growth.
We also had the latest survey from the Fed, the Beige Book report, and it seemed to underscore the risk facing the economy, where overall activity declined slightly, but all 12 Fed districts did report elevated levels of uncertainty, and this seems directly correlated to the story on tariffs. Wouldn't you agree?
There's absolutely no question that that is correct, that the uncertainty is highly correlated to the tariff policy reality, not only the difficulties of the policy, but the uncertainties around the policy, including implementation, timing, and just various expectations. So I expect to see more of it in data that we find out throughout month of May. There was a really compressed reality of productive activity as a result of tariff uncertainty.
But it's not just the story on weaker growth. I mean, the Beige Book indicates widespread expectations that both cost and prices are going to rise at a faster rate going forward. That sounds like a recipe for stagflation, which is the big concern.
Well, if that were the case, the bond market, you would see tip spreads widening. I just simply don't believe that we're seeing that. I think that we mix up the definition of inflation sometimes. I think that it's very true that tariffs raise prices on certain things. But if inflation is indeed a monetary phenomena, in theory, what it's doing is pushing prices higher on autos or steel, aluminum, and yet pushing prices lower on other things. My bigger fear as to why I see them as problematic is that they force a lower level of productive activity, a lower level of trade. So I would be worried about the stag portion, but not the inflation portion. I think there's downward pressure on prices, and I don't say that is a good thing.
So where does this leave the Fed at the end of the day? We've got a policy decision in a couple of weeks.
Well, it's pretty clear in the futures market that they don't intend to be cutting rates at the next meeting. The futures curve is indicating September. Do they end up acting in July? It's possible. It's not 0%, but I think you're going to get 2 to 3 cuts by the end of the year. And the question is more if you're going to start getting them a little bit sooner than later. So you get a couple other weak economic points, this ISM services today, the ISM manufacturing the other day, the ADP number today. If you get a couple tag on negative economic data points, that will start more of a narrative of the Fed doing so sooner than later. But I don't think it changes the terminal for the end of the year. I think at the most they're going to cut 75 out. It's just a matter of when they start.
So let's change gears, if we can, talk a little bit about the equity market. Are you still constructive on U.S. stocks?
Well, I am, but it requires someone being selective. It requires someone having a value orientation. I do not think that I'd be constructive on buying 40x, 40 PE stocks, hoping they go to 50 PE. And in some cases, that's been conservative. So unfortunately, for cap-weighted index investors, they're still heavily, heavily reliant on a few names. And I think that's going to prove to run in place for quite some time. But where there is better value, better opportunity, better, PE ratios, and yet organic earnings growth, ourselves as dividend growth investors are very focused on some of those names. And we think there's some good opportunities in financials, in healthcare, in consumer staples, and energy.
Without naming a specific stock or a specific company, are there generalizations that you can make about certain industry groups right now that you believe have some type of advantage?
Yes, and again, I'm happy to talk individual names if you want me to, but if you'd rather I just talk sectors, that's fine. I think, like I said, the midstream energy sector provides a lot of great opportunity. There's very attractive yield spreads and very healthy financials. And so that sector to me is attractive regardless of where some of these issues around tariffs go. Similarly with healthcare, they've kind of priced in a lot of bad news. Some of the pharmaceutical names, there's this fear of the pricing executive order. There's a lot of upside possibility because some of those things that the president has threatened are at risk of not happening once courts and Congress and other things get involved. But at the end of the day, the bad news seems to be disproportionately priced in. So we think pharma and energy offer some great opportunities where you're not trying to buy a stock at 30 times earnings.
What about the financials? We were talking a moment ago about your expectations for lower interest rates, a slower economy. Does that necessarily mean that you want to put money into the banks right now?
No, I think when I talk about the financials, we're talking about asset managers. We're talking about some fee-based type businesses. There are a couple banks we own that we like, but as a group or as a sector, I think that the overall business model that's just requiring net interest margin is more difficult. But again, the commercial banks tend to be more pro-cyclical, and even in good times are pretty boring businesses. There are a couple we like, but the financials includes more than just the banks. And when you look at some of the asset managers, there's some good opportunities there.
Before I let you go, David, I have to ask about opportunities offshore and whether you're compelled to look at markets elsewhere, particularly in Asia.
Well, we're more bottom-up investors, and so the top-down side, meaning looking at a country to provoke opportunity, is a little bit different than our process. What I would say is if one has a weak dollar thesis, so they believe that the end result of a lot of these trade deals is going to be the administration wanting a weaker dollar, then I think emerging markets are finally going to get a little better tailwind. And so we wouldn't mind emerging markets. But in terms of the developed Asian, developed European markets, it's hard to get real bullish there.
David, we'll leave it there. Thank you so much. David Bahnsen there. He is the founder, also the CIO at Bahnsen Group, on the line from Newport Beach, California, here on the Daybreak Asia podcast.